Welcome to Simon Says Trade. Today we're going to teach you the importance of managing your risk through focusing on how much you could lose, rather than on how much you could make. The best way to know if your position size is correct, is to ask yourself, would I be happy if I lost 1R on this trade? If the answer is no, then you're risking far too much of your capital. But first, let's answer the question, what is R? R is another term for your risk, the amount you're willing to lose per trade. We will always advocate limiting your losses to -1R and having a minimum target of 2R for your winners. The fastest way to blow up your account, and lose all of your money, is to go all in on one trade. Let's be real, nobody knows what's going to happen next. At best, each trade is a coin flip, with 50-50 odds. Using that coin flip analogy, here is risk management in a nutshell. We'll flip a coin 100 times, heads equals $2 win, tails equals $1 loss. With 50-50 odds the results are 50 heads, times $2, equals $100. 50 tails, times -$1, equals -$50. Total profit, therefore equals $50. We won half the time and made a profit. That is risk management. Position sizing is just as straightforward a concept, where best practice is to only risk 1% of your account on each trade. The key elements to calculate position sizing are risk, and stop loss. Let's take a look at an example on a chart. Here's a trade we took on Apple which was trading around $135. For this example, let's say we have a $1,000 account. What is our risk? 1% times $1,000 equals $10. What is the stop loss? According to the cup and handle pattern, we should place our stop just below the low of the handle, so that is 134.40. And our entry is at the break of the high of 135. So, if our entry is 135 and our stop is 134.40, then our risk equals 60 cents per share. Since our trade risk is $10, therefore the number of shares we can purchase is equal to $10 risk divided by 60 cents stop loss equals 16 shares. Reward is the final piece of the puzzle. Every trade should have a minimum target of 2 times risk. So in this Apple example, a 60-cent stop loss requires a $1.20 win. We would therefore look to close the trade at a minimum of 136.20 for a 2R win. So, to wrap this lesson up, you want your risk to be small enough that you can survive a string of losses, and your winners to be twice the size of any losers. With 50-50 odds, you'll come out on top over time. If you enjoyed this video, and want to see more, please like and subscribe. Happy trading and see you next time.